All right. Well, I know people are still coming in, but in the interest of time and considering that we have quite a bit of ground to cover, we're going to go ahead and get started. I want to welcome everyone to our quarterly market update webinar. I am pleased to be joined with Drew Culver, who is a client investment advisor. My name is Greg Estes. I am the Chief Investment Officer of May Barnhart Investments. Um, May Barnhart Investments is a part of Counselor Buchanan and Mitchell, which is a full service accounting and advisory firm. In May Barnhart Investments, we offer a range of financial planning and investment management services for our clients. So just to kind of give you an overview of what we're going to be talking about today, obviously kind of the headline is the Iran war, which began really right at the end of February, and what that means for kind of the outlook for the global economy, for the US economy, et cetera. And then moving into kind of what the market's been doing and some context for the market so that we can kind of understand what's happening now and have we seen something like this before. Then we can go into equity markets, understanding earnings and valuations and where things are moving and where they might be shaping up for the year. And then last but not least, moving into fixed income and interest rates and what the environment looks like for the bond market. So as I said at the top, obviously the kind of the headline story globally has been the Iran war. And really the impact from the war has been, um, you know, the impact on the oil markets, on supply of oil, and what that means for everything else, because energy is such an important component for many businesses and for consumers as well. So obviously, when you have a conflict of this nature, it's going to, result in kind of a spike in energy prices, but primarily that's caused by the fact that the traffic through the Persian Gulf, and the Persian Gulf represents about 20% of the global oil supply, has really been choked off. So the map on the left is showing you the Strait of Hormuz, which is a pretty narrow entryway into the Persian Gulf. To the north of the strait is Iran, and to the south is Oman, and then the UAE, as you can see on the very tip of this landmass jutting north into the strait. And typically, you can see the direction that traffic moves in and out of the strait, and even an alternative route. Effectively, as the conflict began, Iran essentially shut down the strait by attacking anything going through and threatening further attacks for anything that attempted to go through, as well as laying mines. Of course, at this point, the actual shooting has stopped for the most part, but now the U.S. has imposed a blockade further south into the Gulf of Oman. So the takeaway from this is that tanker traffic has crawled to a virtual standstill. So if you look at the chart on the right, it's showing you the different kinds of traffic that move through the strait. And you can see clearly what is before the conflict and then what is after the conflict. So really nothing is moving through the strait, which does have an impact on oil markets. So this chart is just showing you the price per barrel for crude oil, and specifically Brent oil, which is one type of oil. It's originally Brent it originates out of the North Sea, but it's become sort of a global standard for the price per barrel of oil. And you can see the spike in 2026, and it's due to this conflict and the limited amount of supply. And then with the cessation of hostilities, at least the shooting part, we're still in the kind of the blockade phase. The price per barrel of oil moved, sharply up from say 60 to close to 120. Now it's back down into the mid 90s. This situation isn't resolved, so I would not expect the price per barrel of oil to move back down to where it was. Although if we do come to some sort of agreement between the belligerent parties, we might see some more moderation in the price per barrel of oil. At this point, it's kind of hovering in the 90s range. Just to kind of tie this back to consumers, this is looking at gas prices. So you can see how much those have jumped. And this is, dollars per barrel. And one thing to note here, because you might be saying to yourself, I don't pay $3.04 a gallon. This is no tax. So this is just the price per barrel of oil traded on an open market. So obviously the price we pay at the pump is a bit different than this, but clearly, again, replicating kind of the same pattern that we saw with the price per barrel of oil. You see the big spike. Yes, oil has been higher in the past, and so has gas. Nonetheless, it's an important component. It's an important input. It's an important input in a lot of businesses. And for consumers. So, any kind of rapid price increase like this is going to have an impact on people's wallets and their spending going forward. So just to kind of, this is I think an interesting chart because it does put some things in perspective, and it's a multi-decade chart. So it goes all the way back to the mid 60s, and it's called oil intensity for the US. And really the way to think of this is how much oil does the US consume as sort of a unit of output of the economy. So what you can see is the trend has been that oil intensity in the US has gone down over time. The economy has expanded, but B, as the US economy shifted from more of a manufacturing-based economy to a service-based economy, oil became less important. It's still important, but less of a factor because manufacturing is much more, oil is a much more intensive part or a necessary part of manufacturing versus service. That's not to say that oil still doesn't matter. Obviously, just ask, Amazon for their delivery fleet. I'm sure the increase in gas prices does impact them, although there's also kind of the offset for alternative sources of energy, which do help with oil intensity and reducing the level of oil intensity. So kind of the takeaway from this is that the US is a bit more insulated from the price of oil than it has been in the past. And this is even not even looking at the fact that now the US, due to fracking technology, actually produces more oil than it consumes. So it's a net exporter of oil in the global market. Just kind of shifting to the US economy, it does continue to grow. The blue line represents sort of a growth rate in real gross domestic product, which is basically the US economy's total output. And you can see it's hovering right around that 2% level. So, that's in the growth territory. It's been higher, it's been lower. It has come off a bit from where it was maybe a couple of years ago. So it's slower than where it had been, but nonetheless still, kind of, I'd call it plugging along. It hasn't really dipped into any sort of recession. You can see in this chart, the gray lines represent, or the shaded areas represent recessions, and we have not had one since the COVID-induced recession back in 2020. Okay, so talking about the overall economy, it's growing, maybe slower, but still growing. What about the labor market? The labor market is softer than where it had been in the past. And the chart we are looking at shows you the amount of jobs generated on a monthly basis in the US economy, going all the way back to 2022. So the most recent number was March, 178,000 jobs created, which was quite a lot better than expected. But one thing that may jump out at you is in these most recent months, the ones further to the right, we seem to be swinging between positives and negatives. There's a lot more variability in this. Um, I suspect that a lot of this is due to the fact that the labor pool itself has gotten a lot smaller over the past year and a half due to the administration's immigration policies, which have the shrinking that labor pool means it's there's less of an abundance of available workers, which means that a lot of companies that may have been wanting to hire people may just forego doing it. There's also the potential that, with things like technology and artificial intelligence, that's led to higher levels of productivity, which means that companies may be looking to hire fewer people, and trying to squeeze more out of the existing employed labor base. But nonetheless, the general trend has been slightly positive, although not as high as you see in 2022 and 2023. Um, Kind of not in this chart, but also something to bear in mind is that jobless claims have continued to trend down. So that has been a positive. So in other words, we're not seeing a higher level of joblessness. But what we are seeing is that for those that may be out of work and want to find work, it's getting harder to find a job. So this chart is looking at the share of unemployed workers that were able to find a job the following month. So within 30 days of losing or leaving a job. And that percentage has gone down. And as a matter of fact, that percentage is lower than where it was in the early stages of the last three recessions. So it's taking longer for people that are out of work that want work to find a job than it had been in the past. So this is considered a slower labor market. Of course, the issue is for the Federal Reserve, which kind of controls interest rate policy and has this dual mandate of trying to maintain uh, full employment while also being worried about inflation, is that if they cut rates to stimulate jobs in the economy, that could have an inflationary impact. So that's kind of the balancing act that they have. And right now, the inflation impacts seem to be, they've trended down. So we're looking at two measures of inflation. The red line is personal consumption expenditures index, and the yellow line is the consumer price index. So what these are showing you over time is the rate of inflation for the previous 12 months. And you can see how high it was in 2022 when inflation was, had spiked. And the Fed, responds to higher levels of inflation by increasing interest rates. In this case, the blue line represents the Fed funds rate. That's what the Federal Reserve controls. So you can see that they were a little bit late in responding to high inflation, but did move rates up to 5.5%. And then, in 2024, cut rates a few times as inflation trended down. In 2025, cut rates again three times as inflation was lower. But you can see, inflation isn't really trending necessarily from what we can tell to the 2% line. The 2% it's not a magic bullet or anything like that, but it is kind of considered a long-term target for inflation. Um, and as a matter of fact, PCE appears to be bouncing back up over 3%. So, again, going back to the balancing act of the Fed, would they really want to necessarily cut rates if inflation weren't clearly moving to 2%? It's kind of hard to tell. So, they're kind of balancing that with where they think the total level of employment is. And at this point, for the most part, most of the voting members of the Fed seem content to keep rates where they are. Um, Kind of on a side note, so I had showed you what personal consumption expenditures, which is one measure of inflation, what that looked like in this chart. That PCE number is this dark blue line going all the way back to February of 2000. And you can see at the far right how it's kind of bounced up like I showed you in the previous graph. Well, there's this other measure of PCE called trimmed mean PCE. And what that means is we kind of throw out the biggest ups and the lowest drops in inflation and kind of look more at like an average or what they call a trimmed mean. So it kind of stabilizes that PCE. So what's interesting about that is it's showing an inflation rate that's actually getting close to the 2% zone. So what the reason I find this interesting is that the most recent nominee to chair the Federal Reserve, Kevin Warsh, seems to be a big proponent of this trimmed mean PCE estimate, which kind of implies that what he would see on this is that inflation is headed in the right direction and that we could indeed cut interest rates. He seems to be in the minority among voting members at this point. He hasn't been confirmed as the chairman either, but I just thought this was interesting because it kind of shows you some of the different thinking that might be going on inside the Fed. Whether you believe that inflation is actually trending down or if it's kind of blipped back up. And again, we're talking about core measures. Core measures are a little bit different than overall inflation because they exclude food and energy. And obviously, energy is the huge component, the big variable that has spiked in recent over the recent weeks due to the conflict in Iran. So even core measures, though, of PCE have kind of blipped back up, but the trimmed mean PCE has not. It's trended back down. So it's something to follow, that we will follow as the new nominee goes through the process of getting approved, and whether anyone else on the Federal Reserve that is a voting committee member actually agrees with this or not. Kind of my last opening comment is about tariff rates. It seems like a lifetime ago that we had the announcement back in April of 2025 on what was touted as Liberation Day of these large new tariffs that the administration was implementing. And they were using a very specific International Emergency Economic Powers Act to push through these tariffs on a wide range of countries. And you can see the effective tariff rate, this dark blue line, where it was before Liberation Day. It was between 0 to 5% of tariff rates for goods coming in the US, and how it jumped to almost 20% at one point. And then over time, last year, kind of dropped back down in steps, mostly down, as different kind of events occurred. And you can see that at the beginning of this year, the Supreme Court ruled that the administration can't use that Emergency Economic Powers Act to implement tariffs. So the administration quickly pivoted to using Section 122 of trade code to try to extend these tariffs. The only problem with that is that there's a limit on how long that Section 122 can be used for tariffs. So, barring nothing else, we're likely going to see tariffs move down again. I bring that up because that's generally constructive for global trade and for business to have lower tariffs. So you can see this red dashed line, the expiry of tariff rates and what that might mean. as we could theoretically be going down below 10% tariff rates, again, this would be, I think, a positive development for markets. And with that, I'm going to turn it over to Drew to kind of cover equity markets and give you guys some context on what's going on here.
Perfect. Thanks, Greg. So on this chart here, we're looking at equity returns thus far through the beginning of the year. So if you look all the way to the right as of the end of last week, the four different indices that we're looking at, basically large cap in blue, mid cap red, small cap green, and then international purple are all positive. You can see they all started the year quite strong. Large cap, pretty neutral through the first 2 months or so. And then we saw a pretty poor March following the beginning of the war. However, April, we've had a pretty nice rebound as reduced geopolitical risk have come through, as well as we've had pretty strong start to corporate earnings, which Greg will go over with you a bit later. So, and then so just kind of putting things in perspective. This is the number of times the S&P 500 has had a 5% pullback by year. So thus far this year, we've had one. Last year, we had six, even though we still ended the year double-digit positive. So it's very normal to have these pullbacks. And on average, you can see that we've had around 4.6 pullbacks of 5% or more each year within the S&P 500 dating back to 1980. And then on the next page, if we take a little bit deeper of a dive, this is a breakout of the actual 500 companies within the S&P 500. So on average, that top dotted green line, on average, at some point throughout the year, the 379 companies experience a 5% drawback. And then lower, that gray dotted line, 151 companies in the year on average down 5%. So even though 75% of the stocks within the S&P 500 experience a drawdown of 5%, we still end the year positive roughly 75% of the time. So it's, again, very normal to see these drawbacks. The corrections happen all the time, but we still end up positive around roughly 75% of the time. And then again, just looking back at historical crises, you can see a handful here, but 12 months after the peak of a geopolitical risk, we still average a 15, almost 15.5% positive return afterwards. Certainly there's cases where there's those double-digit negative returns, but even though wars and such aren't always very ethical, it does have a big influx of spending into different companies, especially the defensive side, that does buoy the market up a fairly decent amount of the time. So again, these conflicts occur, but still the market does continue to grow. And you will see that, I believe, on the next page as well. So again, even longer look back, so dating all the way back to 1928, a bunch of wars along the way, but you can see the trajectory of the S&P 500 continues to grow. You will see correlations, the short-term blips downward, but the market does continue to grow. We do believe that still 5-10 years from now, that the market is very, very likely to be higher than it is today. And staying invested through these times of turmoil is certainly important. And kind of speaking to that, so we definitely don't recommend pulling your funds out of the market, mostly because it can be extremely difficult to time when to put your money back into the market, and the opportunity cost there can be pretty significant. But this is looking at if you invested your money into 4 different areas over the past 20 years. So if you put your money into cash, you would have actually lost money. So starting with 10,000 inflation adjusted, you would have ended in with $9,798. Whereas if you had bonds up almost 20 up to 24,000, small cap 55, and large cap would be all the way up to 90. So large cap has certainly been the winner the past couple of decades. If you look longer term, small cap would take that over. But being invested in equities, we do believe is important where you'll make the most majority of your money. We do still believe in having those bonds there, though, in times of volatility to kind of stabilize your portfolio. And then lastly, before I hand it over to Greg, this is what we refer to as an asset quilt. So it looks like a lot, but if you look at the top of each column, there's a year. And then the top row of that column is the best performing asset class for that year. So for instance, year to date, commodities have been up the most at almost 24.5%. And then the worst performer was negative 4.3%. This was as of the end of March, so a little delayed in reporting. But those have turned positive now, large cap. But for instance, if you look at 2025, we had emerging market equity and developed market equity as the leaders. So two international stocks led the way. But then if you go over towards 2018, for instance, 2021, emerging market equity was the worst performing asset class. So it can be very difficult year by year to predict which asset class is going to be the best performer. So just another reason why we continue to strive diversification. So hopefully reduce risk along the way with better and more predictable returns. So on that, I'll hand it back to you, Greg.
Thanks, Drew. Okay, so let's talk about some of the more fundamental aspects of the stock market, and I think at the most important, the first level for anyone that's investing in stocks should be earnings. What are my companies? What are they earning, right? Because over time, you expect companies to earn money, to grow that earnings, and thereby grow the value of the business, which in turn should lead to higher stock prices going forward. So that's really the name of the investment game, so to speak. So how have S&P 500 earnings looked on a quarterly basis? We're going back to the second quarter of 2022. How has earnings growth looked on those multiple quarters? So there are a couple things to look at in this chart. The first one, the gray bars represent expectations for earnings growth by the end of that calendar quarter. So for example, if you look at the second to the right, the second furthest right column, Q4 2025. Okay, Q4 ended on December 31st. The expectation at the end of the quarter, and what we mean by expectation here is these are analysts that follow these stocks and have expected levels of earnings growth. They believed they would see 8.3% earnings growth versus the prior year period. The blue line represents the actual growth rate for once all those companies report. Now, there's a lag on the companies reporting. So, for example, for the quarter ending December 31st, most of those companies don't start reporting until February and well into March. So when all is said and done, that growth rate was not quite 14%. So if you look, so then the blue bar represents the actual results and the gray bar is expectation. So if you look at the rightmost column, Q1, which ended March 31st, right now that's right. We only have an expectation of that, and it's an expectation of 13.2%. Some companies have reported, but not all of them yet, so we don't have a final figure. A couple of important notes here. The first one is that if you look at the blue bars, you can see that earnings growth has been pretty strong from 2024 on, and so that I think that's going to continue to bear out. The second point to make here is that the expectations have actually gone up over the last few quarters. So the gray bar for Q1 is pretty high compared to what it had been in the previous several quarters. So there's this idea that what I find interesting here is that most people, if you're overly focused on geopolitical crises, you may not realize that there's an expectation that's been going on that earnings are going to grow for businesses. So that's a positive for people that want to invest in stocks. Looking at this a little bit differently, we can look at it on instead of a quarterly basis, we can look at it on an annual basis. So you see these different colored steps, those represent the years. So 2025, that's in the books in purple. 2026 is our next year up in kind of that red color, and then 2027 in green. So they're each a step higher because there's growth involved. This chart, the blue line, represents actual earnings in the S&P 500. So it's not really a growth rate, it's the total level of earnings in the S&P 500. So that's why you can see it kind of trending up over time. It did take a dip in 2020 as, things shut down and that caused companies to show declines in earnings. But since then, it's been pretty strong growth, and that is expected to continue into 2026. Interestingly, these little dotted lines, those represent consensus, meaning, if you looked at all the estimates for analysts that follow these companies, what do they think the earnings level is going to be? So, and that's looking forward. You can kind of see how these dotted lines are trending up, meaning that there's an expectation of improving earnings, which would be higher growth rates going forward over the next couple of years. So, we talked about the S&P 500. Those are large cap stocks. What about mid cap stocks? So again, we're going to go back to this is earnings and revenue expectations for mid cap stocks, specifically the S&P 400 mid cap index. And the way to look at this chart, it's not so much showing you growth rates, it's showing you the change or revisions in those rates. So right now, analysts expect mid caps in the S&P 400 to grow between 13 to 14% for 2026. If you look at the blue bars, that kind of gives you an idea of any revisions. Right now, there aren't any positive or negative revisions in those earnings estimates. But if you look at that red line, you can see that revenue revisions are trending up, which means that, we can't necessarily connect the dots immediately, but usually when revenue starts to be revised up, at some point you might see earnings also start to be revised up, or for companies to report better than expected earnings. So if we harken back to the chart that Drew showed for market performance year to date, we saw that small and mid caps were doing very well. This is kind of explaining why. So small and mid caps have been kind of relative underperformers to large cap stocks over the past few years, but with expectations starting to improve on their performance, and what I mean by performance here is revenue and earnings, there's more momentum, if you will, or interest in small and mid cap stocks among investors. So that partially is explained by these revision estimates. Small caps as well. If we were to look, it's not in this chart, but roughly right now, analysts expect growth of about 15% year over year for 2026 for small cap stocks. And again, it's somewhat of a similar story to the mid cap stocks, which is to say that we're seeing revenue revisions move up. So the change in the rate of change, if you will, sort of an acceleration in revenue, which is a positive thing. Not so much showing up yet in earnings, but that will remain to be seen. Okay, so I like to kind of every once in a while check in on this chart. This is showing you how expensive different parts of the stock market are. And this is really just right now, we're just talking domestic. Um, so we have in purple, that's the Magnificent Seven. These are really like the biggest seven companies outside of Exxon. They're all technology related. The list of them is down below, Google, Amazon, Apple, Facebook, Nvidia, et cetera. Um, that's in purple. Then everything in the S&P 500 is in this reddish color. And then the S&P 400 mid cap in blue and the S&P 600 small cap in green. So what exactly are we looking at? We're looking at price to earnings multiples, forward PE multiples. So what does that mean? The way to think of that is how expensive is $1 of next year's earnings for this group of companies? And so if you, for example, look right now at the S&P 500, it's $20.5 for every dollar of next year's earnings. Okay? That's how expensive a dollar of earnings is for the S&P 500. The Magnificent Seven is more expensive as a group. And then you have the S&P 400 mid cap and the small cap stocks that are multiple turns cheaper than large caps and especially the Magnificent Seven. Why am I making a big deal about this? Well, there are a couple of reasons. One, you can see that the relative valuations back in 2013, 14, 15, they were much closer together. Large caps aren't necessarily, they're not fated to be more expensive than other parts of the stock market. They simply are more expensive right now. And a lot of that's due to the attention being drawn and the earnings growth that has been generated by the Magnificent Seven. They've really been driving that large cap multiple. And so they are quite a bit more expensive than other parts of the stock market. The other thing I want to point out here is, and you can see this pretty clearly, how much more volatile sort of the PE multiple is for the Magnificent Seven. So when equity markets were selling off in March, and everything really sold off in March, you can see these multiples drop in these different categories. But where do they drop the most? They drop the most in the most expensive parts of the market, in this case, the Magnificent Seven. So we had been talking about making sure that one's portfolio wasn't too heavily skewed towards these really big tech companies. And part of the reason for that is they got pretty expensive. And hey, let's have a little bit of risk control in the portfolio, and move towards areas that maybe aren't as expensive. We can't prevent the stock portfolio from going down when everything goes down, but maybe we can mitigate some of that steep decline that you might see in some areas of the market versus others. So then what about international stocks? So this is looking more broadly at, in red, the all country world index, excluding the US, so everything outside the US. How expensive is that? Versus everything in the US, so all market caps together. And you can see that the international area is still cheaper than the US. And again, it wasn't always the case that US was more expensive. It has been in recent history as the US economy has done pretty well relative to other countries. I would consider having international exposure as an important diversifier in your portfolio. Just based on these multiples, I wouldn't rush out and make your portfolio entirely international stocks, because there is more volatility there, and there's a lot more variability in economic growth rates across different countries outside the U.S. But nonetheless, given kind of its relative value versus U.S. stocks, I do think it earns a place in a portfolio. We can also look at a kind of a different dynamic going on here, and that's kind of growth versus value, and how much growth represents in the S&P 500 index. So growth stocks tend to be the ones that are more expensive, that have higher potential earnings growth rates. Value stocks tend to be more stable businesses. They pay dividends. They're not as expensive, but maybe those growth rates aren't as high. So they're kind of two different flavors of stocks. You can see that the percentage of growth stocks and the representation in the S&P 500 has grown pretty significantly versus value stocks. And that a lot of that is generated by the Magnificent Seven, which represent, close to 40% of the index itself, the S&P 500 index. The reason, again, to point this out is if you're just owning an S&P 500 index, this is what's this is what's transforming in that index, is it's becoming very much a growth oriented index. So there might be ways for you to kind of counterbalance that by looking for, you don't have to go to an actively managed fund, but there might be some sort of passive ETF that focuses on a value index, like an S&P 500 value index ETF, that you can add to your portfolio to kind of try and get a little bit of balance in there, so that you maybe are not quite as exposed to the really expensive parts of the market, which, in periods of volatility, you can see how much they move around relative to value stocks. So this is just showing you kind of that, what I was talking about, the how expensive one area of the market is versus another. And now we're just looking at the S&P 500 growth versus S&P 500 value. We expect value stocks to be cheaper than growth stocks. Investors are usually willing to pay up for potential earnings growth. But again, if we look at recent history, you can see both categories, those PE multiples did move down, but they moved down a lot faster and a lot harder in the growth area. So there are a couple takeaways here. One, growth stocks can be much more volatile, especially when they get more expensive, and that relationship between growth and value gets kind of out of whack. The second point is that growth stocks have gotten much more reasonably priced relative to value stocks at this point. So, in other words, kind of a lot of pain has already kind of subsided through the month of March. So that was a pretty quick sell-off in growth stocks. But if you were heavily invested in growth stocks, you probably did notice that your portfolio was maybe down more than the index as a whole or other areas of the stock market. Okay, I've gone on for quite a while on the fundamentals of the equity market. I'm going to flip back over to Drew, who's going to touch on fixed income markets.
All right. So this is similar to the asset quilt that we looked at earlier, but for this one, we're actually looking at bond sectors. So if we start looking at 2026, the top two performers, the ones that are positive, have been mortgage-backed securities, treasury, and inflation protected securities. So ones that are definitely more tied to inflation, because we've seen inflation rise, interest rates tick up a bit. And then you'll notice the other bonds have actually been still relatively flat, but leaning slightly negative. 2025 was a different year, whereas we saw bonds across the board really do quite well because we saw interest rates and inflation coming down. Longer term, if you look at the average all the way to the right, high yield emerging market debt, U.S. hedge have been the better performers. Those typically have a little bit higher yield, a little bit lower credit, so more risky. So longer term, the more risky bonds do pay off. However, in a lowering interest rate, those don't perform quite as well historically. So. And then now looking at different interest rates across different things. So the purple line represents high yield corporate bonds. Green is 30-year mortgage rates. The red line is the 10-year, and the blue is shorter term of the 2-year. So you will notice that we actually had a blip up there in 2026, and that was largely due to the conflict occurring. High yield, the spread has increased there slightly. So we have seen an uptick there pretty much across the board in rates, not huge at this point, but we have seen that start to tick up, which has been pretty negative for bonds overall. And this is looking a little bit shorter term, but we're looking at the 10-year US Treasury bond yield. So most recently, looking at the Persian Gulf, after that occurred, you'll see a pretty significant jump there of the 10-year Treasury. We do believe that as things normalize, we'll kind of go back to where we were. But the conflict has certainly pushed those rates up as inflationary concerns have come into light. So as those settle, we do believe bonds will have an opportunity as well. And so something that we're continuing to keep an eye on. And then lastly, just wanted to kind of discuss portfolio drift and the importance of rebalancing. So this is looking at if you started with a 60% stock, 40% portfolio back at the end of 2019, how it would have adjusted over time. So if you started with that 60-40, currently based on market returns, your portfolio would be about 71% stock and 29% bonds. So kind of closing your eyes and letting your portfolio swing with the market can certainly make you more aggressive. I mean, if the market would go down, you'd be underbalanced stock. So it's definitely really important to rebalance. Rebalancing in itself is the act of buying low, selling high. You're selling something that's done well. Your portfolio's drifted that way, and then so rebalancing, you're purchasing the things that have underperformed and are so buying low. So just as a reminder, that's definitely important to rebalance, look at your portfolio on occasion, make sure your risk tolerance is where you want it, aligned with your goals, time frames. So really important to just monitor your portfolio overall. So I believe with that, I think we're going to open it up to questions, Greg.
Yeah, so if you have a question, feel free to submit it in the chat. We did have a couple of questions, I think on the front end when during registration period, and one of them was, and I'm going to paraphrase it, but is this a buying opportunity? I guess the way I would characterize that is. It wasn't a very big pullback. If we go back to, let me see if I can do this. I'm going to just go back to the actual market return chart. There it is. It was roughly, a 10% pullback maybe in certain categories, but like a 5 to 6% pullback tops in large caps. Hindsight is 2020. Sure, it was a buying opportunity, but it wasn't really a very big move. What I would characterize it more as an opportunity to exercise discipline. In other words, don't panic, don't sell things just because of headline news. It's never gonna. It's usually not going to work out well for you if you are motivated to sell based on headline news. And I know sometimes that can feel wrong, but as human beings, we are actually kind of hardwired for self-preservation, kind of the fight or flight response. And sometimes we can port that over to our investment behavior. So I would simply say, stay the course. I would expect, given the administration, something else is likely to happen. I am going to focus on fundamentals for equity markets, and the long-term move in rates is generally down, which is also positive for being, more intermediate in bonds. So I would say stay the course and, we keep following earnings growth and fundamentals of businesses. I believe there was one other question and it was on private debt and private equity. Um, and I know that private debt has kind of been in the headlines quite a bit. I guess the first thing I want to point out for the good of the group is what exactly is private debt or private equity versus public debt and equity. So, when we look up stocks, like if you go to Yahoo Finance and you look up a stock or you look up a mutual fund or an ETF, those are publicly traded. You can go and buy, in your Schwab account, you can buy a stock. You can see what the price is. You can see what it's traded at, over history. You can do all kinds of things. And usually the price that it says, as you're trading it, the stock is so liquid that that's the price you're going to pay, or that's the price you're going to get if you're selling. So that's public. Public debt is kind of similar, although the mechanism for trading is a little bit different. There are bond traders. You might have to call someone to get a particular bond. Sometimes a Schwab or a Fidelity has bonds in its inventory that they can sell you. Um, these are public, which means that there are requirements for filing. These companies have to file with the Securities and Exchange Commission all kinds of information that you can read. If you go to the SEC Edgar website, you can read all about how they're performing. If it's a bond, these bond covenants can be really, really long, hundreds of pages, but all that information is out there in public. Private equity and private debt is a little bit different because it's more direct, and you are, uh, you know, at the core, you are buying a piece of a business directly, and you are more of a direct owner in that business. Now, private equity has gotten big in the sense that people now give their money to an active manager who then takes a pool of money and then looks for investments and then places it directly with a business, and might have different kinds of ownership in different businesses. And you may have some sort of private equity fund that is a mix of different private equity deals. Private debt is very similar, except now instead of owning the business or owning a piece of it, now you're lending money. And the reason that private debt has gotten into the news is that a lot of companies that have sprouted up with these investment vehicles to place private debt with potential businesses, is that a lot of those loans are being made to software companies. And what have we seen a lot of news recently has been about artificial intelligence and the potential for disruption of software businesses. So if you're lending money to a lot of software companies, and they could theoretically be getting disrupted by artificial intelligence, meaning maybe we don't need a lot of coders to create this software code. That could not bode well for those software companies. And if you're lending them money, the name of the game is getting paid back. So there's a lot of concern about private debt, and particularly who they're lending to. And I say all this because most people aren't going out and making direct loans to companies, right? They're using some sort of an investment vehicle. There's like companies like Blue Owl, I think maybe BlackRock. There's a lot of different companies that are doing private debt. Um, y- you know, the what is the expression? Buyer beware. You have to know what this company is, who they're lending to, right? So it's kind of the onus is on the investor to look at who this investment management company, who they're lending the money to. So it is a different animal than publicly traded debt and equity, because there are a lot fewer disclosures there. And I think a lot of investors maybe were taken by surprise, thinking that private equity, private debt, they'd shown some really positive returns over the past number of years, and so people tend to want to buy something that has done well in the past, and maybe is getting disrupted right now. I do see a question, and I apologize, Drew. Do any any thoughts on private debt?
No, that was well covered.
Yeah, I probably went on too long on it, but tariff refunds, are they expected to have any change on the domestic market? You know, I would say this, usually anything that's already out there in public domain is kind of
Baked in.
already in the price of a stock. So, um, the likely refunds are going to go to businesses, and they will start to disclose in their earnings calls if that really matters at all in their earnings. Usually, when if they say, "Oh, we're going to get a big refund on tariffs, and it's going to add, such and such to our cash in our on our balance sheet," um, analysts that follow these companies will consider that a one-time event. The real event is maybe that tariff rates might go down for a longer period of time, and that would be, beneficial to everyone involved. Not so much getting the money back, but it certainly is a slight benefit to some of these companies and their balance sheets if they can get some money back from the administration from tariffs collected. Do we have any other questions? We've only got a couple of minutes left, so I didn't know if anyone might have one last minute question here. Like I said, we expect earnings to continue to grow. At this point, things look pretty good. If oil stays elevated at these levels, it could crimp some of the increasing expectations, I guess, of earnings. But at this point, we're not looking at earnings decline. So, I think it's generally shaping up to be a pretty positive year so far, despite everything that's been going on globally. All right. Well, with that, I think we're going to wrap it up just a couple of minutes ahead of time. I want to thank everyone for turning out for this event. And, on behalf of Drew and myself, we look forward to seeing you at our next webinar. Take care, everyone.
All right, Greg, I'll shoot you one. So, do
Okay.
you believe the market will have a correction in the new year?
Well, based on kind of the evidence that Drew had covered, at some point, there probably will be a correction. There seems to be a correction every year.
Mhm.
Believe it or not, it's kind of healthy to have a correction, because if markets keep going up and up and up, that just means at some point that the correction could be even bigger, depending on how quickly they've risen. Um, Over a long period of time, if earnings continue to grow, though, that does support stock prices. That's kind of the point I was trying to make. So when we talked about like those PEs and how big they were getting, there's the price on the top, and then there's the earnings on the bottom, and that PE ratio. So if the earnings continue to grow, that supports kind of valuations. That takes longer because those only happen, every quarter. But there's likely at some point to be some sort of a correction. It's difficult to predict when that'll happen, but typically when you get bouts of volatility, that's when you see those corrections.
All right. We kind of discussed currency, but I guess projection for the future value of the US dollar.
Yeah, that's the anyone who tells you they can predict currency movements, just make sure they're not also trying to sell you a bridge or something like that. But it did look like there was support for the dollar, kind of in the range that it's been in. So again, and if the economy continues to perform well, it's got some kind of support. I can't really predict which direction the dollar is going to move, but it does appear like it's got some support.
Another question that I'll take is how to navigate RMDs and avoid minimizing taxable when selling assets in retirement. So, certainly several ways, one of which I mentioned earlier. So if you're charitably inclined, you can do QCDs, which can directly reduce the RMD that you have to take. Another way to go about it potentially would be doing Roth conversions. That's either before you start those RMDs or potentially even when you're doing those RMDs, especially if you're in a year where your tax brackets decrease significantly. Maybe you retired at age 65, you don't have to start RMDs till 73. Your income may be lower through that phase of life. That may be a good opportunity to go ahead, do those Roth conversions, get it into the Roth where you don't have any RMDs. That money's going to grow tax-free forever. And if you have any more questions on that, certainly feel free to reach out to us, one of your advisors, and we can help you walk through that. Another question was, are you aware of any ETFs specializing in essentially cryptocurrency stablecoins? I can take this or you can, Greg, but there certainly are a handful of ETFs or that are out there that do that. I know iShares has one, Grayscale has one. There's a handful that you can certainly invest in. Greg, you may be able to speak. Are we limited in any capacity about market or portfolio saturation, or how much?
Are you referring to, how much to put into some kind of ETF that's, cryptocurrency
Correct,
based, or?
yeah.
I have less of a view on
Yeah.
cryptocurrency as a meaningful investment. That you can, I believe there are ETFs that can kind of get you to the areas that maybe service the cryptocurrency
Mhm.
market, kind of like a blockchain ETF or something
Yeah.
like that. So that at least you're owning a business as opposed to exactly, owning cryptocurrency itself. But we try to avoid holding, you know, cryptocurrency in our clients' portfolios. I do see a couple of questions in the chat, mostly about kind of consumer debt, and there have been some regional banks that have reported losses. Um, and is that a sign that the economy is not as strong as being reported? Should one get defensive now in anticipation of a major market correction? Um, well, I would say there should be some measure of defensiveness in one's portfolio. That would be perfectly appropriate to have on an ongoing basis. So if you are all equity, if you are all heavy into Magnificent Seven, maybe take a look at some of these charts and um, consider that it's might be a good time to diversify your portfolio. If you're light on fixed income, consider that its job is not to make you big bucks. It's to help stabilize your portfolio and generate interest. So the diversification in a portfolio does matter because you're not really going to be able to predict um, when corrections happen. I just kind of a little bit further expanding on that thought. So let's say you do start to see the market, some data that the economy is slowing. That doesn't necessarily mean the market all of a sudden sells off, because the market could get excited that the Fed is going to cut rates, even faster. So there are other elements at play when it comes to kind of forward predictions about what happens in those events. But I would say it's important that you have, depending on your own particular circumstances and working with a financial planner, you have a plan of attack, you have a target asset allocation, and you have exposure to different areas of the market. I do also see a question about gold because I did talk about gold. You know, I would view gold as strictly as a diversifier and as a hedge in a portfolio. Certainly, it's had very strong performance this year. Um, the last couple of weeks, it's kind of traded off a bit. So, you know, not again, I don't want to be a chartist or anything like that, but gold tends to have very strong performance, and it's mostly on kind of an emotional basis, and then it's followed by periods of kind of lackluster performance. Um, if you are going to hold gold, you do it strictly as a hedge. Typically, it's a hedge versus inflation. Now, inflation it does remain elevated, and maybe inflation does move up. So you could think of gold as potentially a hedge there. But remember, gold isn't going to generate a dividend. Gold isn't, you know, it's simply there in your portfolio, you know, based on kind of heightened fears or, you know, chaos, things like that, concerns about like that. That's why you hold gold position. So make sure it's not a huge exposure. If you've got a big exposure, you might want to consider where the, you know, the price of gold is today versus where it was at the beginning of the year. I think I recall there was a question about tariffs, and the
Yeah.
idea that you know, if the revenue generated from tariffs is used to pay down the debt, would that lead to lower interest rates? And this is an interesting question because it kind of gets to um, what's called the crowding out effect, and which means crowding out means like if the government is borrowing so much money and it's issuing a lot of debt to do that, you know, and spending too much money. Eventually, with all of those bonds out there, investors are going to demand a higher interest rate, and so interest rates go up. The converse of that would be, hey, if you can pay down the debt, um, that you know maybe that leads to a naturally lower level of interest rates. And theoretically, yes, but if you kind of look at what the run rate is on the amount of revenue generated by tariffs, so say it's 30 billion in a month right now, that seems to be about what it's tracking. So 360 billion, um, then that's you know, a reduction of, I believe I saw the deficit was about 1.8 billion or 1.8 trillion this in 2025. It's not necessarily a meaningful reduction, and you know, the national debt is around 38 trillion. So, you know, 360 billion, while big, is we still have a long way to go to kind of cut that debt balance and also consider that it's not necessarily true that all of that money goes towards repayment, right? So it's likely that some of that money would then be spent on something else. Um, so, you know, it theoretically, yes, but in practicality, in terms of how much money the tariffs are raising, it's probably more challenging than that. Wow, I see some chat questions, predictions about capital
Yeah.
gains tax in the next 4 years. Wow, I wouldn't venture a guess there. You know, they I don't know if Drew, if you have any thoughts on that.
I don't anticipate them increasing with how the current I mean, the one big beautiful bill just went through. I don't believe there were any changes to the capital gains rate. With Republicans in power right now, I don't see them looking to increase capital gains rate. So again, it's hard to speculate on that one, but I'm not anticipating at least any increases in the next 4 years likely.
Yeah, yeah. Thoughts on the municipal bond market. So the analysis that I've done is you have to be in the very highest uh, tax bracket for municipal bonds to potentially be worth your while because
Mhm.
the after tax yield on, on taxable bonds still tends to be higher than what the yields are on municipal bonds. Did I say that right? The after-tax yield on treasuries or corporate debt, things like that, still ends up being better than the yield that you get on the tax-exempt municipal bonds. And don't, and I would also say be very careful about going out way too long, on municipal bonds. Although with the direction rates are going in, being longer might be better, but getting out really long, you're kind of locking yourself into a muni bond. Also consider that if you are owning little pieces of municipal bonds, they're really hard to trade. That's just a practical consideration,
Mhm.
and you will take a little bit of a haircut if you try to trade that bond. So that's something to think about. Some kind of financial planning questions I'm seeing in the
Yeah.
chat. Um, any I don't, Drew, you're my CFP. I don't know if you have any thoughts on these.
Um, Again, some of them are still going back to taxes. One specific that I'm reading is regarding selling your primary residence. Um, I I'd be surprised if they eliminate it to free up the housing market. I don't anticipate it is what I'll go with, but again, I can't say that anything there for certain, but I don't anticipate that being eliminated. Um, they still have the 500,000 for married couples to sell on the primary residence. So that's it didn't seem like there were any real changes there. So I wouldn't anticipate anything near term there.
Hmm. Okay. Were there any other pre-submitted questions?
Let me review. I guess the only other one that I'm really seeing would be just the general tariff impact on the economy. I know you kind of spoke to the debt, but just the overall economy.
Yeah. So that, when you saw markets decline in April on the announcement of those big tariffs, a lot of that was on concern that it would cause a negative, have negative consequences for the economy. And that also is why a lot of economists adjusted down their expectations for future growth and even started to increase their probabilities of recession. The idea that the tariffs can slow down the economy because they simply make things more expensive. It isn't just about inflation, but it's about, if you make things more expensive, people are going to buy fewer things, right? So if they buy fewer things and I'm a company, I'm now selling fewer things, fewer widgets, fewer services, what have you. So they they classically, the economics says that, introducing a tariff, it is a tax, and taxes, it's a tax passed on usually to consumers. And it's taxes typically have a slowing down or braking effect on consumption. So that's kind of the gist or the impact of tariffs. And what we've seen though is that the actual level of tariffs wasn't as bad as we kind of thought it would be back in April. So that kind of explains, and so far it appears that, I mean, this is just my own read, is that the level that tariffs are at right now is and it's not high enough. People, it's able to be absorbed. Although, I keep reading uh, articles and information that, food prices continue to move up, and that this is kind of getting back again to this, the dual mandate of the Fed. The reason why they focus so much on inflation is because inflation is another tax on people. And, especially for certain segments of consumers on the lower end of the income scale, inflation can hit really hard. So that's why the Fed does pay so much attention to it, and why it, uh, it's very difficult. They're stuck between that rock and a hard place. We got to watch that labor market and make sure it doesn't slow down too much. But by the same token, you got to prevent inflation from running hot for too long. And with that, I think we are about out of time. So, well, I see one last question. So, am I anticipating stagflation or deflation occurring in Q1 or Q2? I would say no to either, because one is rampantly high and we're still seeing economic growth. So stagflation, no. Deflation, we're not really seeing signs of deflation, and that would be typically in a big recessionary or depression type of environment. So that's kind of wraps up the topic for today. Stay tuned for further releases as it's financial planning month, where we've been issuing those weekly, and there are great worksheets that are included. So please be on the lookout for those, and we will see you again in about 3 months. Take care, everyone.